Hey, welcome back everyone to 7-minute options. All right, today we're gonna look at naked puts, and let's see what the naked puts look like. So on the last episode we looked at covered calls. Today we're gonna look at naked puts because they're very similar, right? And I shouldn't use the word naked put. Maybe a better way to say it is cash secured put. All right, CSP is the short form. So let's take a look at this, right? Same underlying X. We're looking at US Steel, and in the last episode, we bought 100 shares and we sold the 29 call to see what the covered call looks like. And let's look at it on the other end. Let's look at puts. So let's say that you like this stock and you tell yourself, you know what, I wouldn't mind owning US Steel. It looks like a half decent company. I wouldn't mind owning the stock. So let's say I want to sell a put option. And now why do I do this? Let's say I pick 22. Well, what happens with a put option is the stock would have to drop to that price on June 18th for me to end up with shares. So let's say I don't want to buy this stock at $25.60, which is what it's trading for now. But you know what? If the price drops to $22, I want to buy it. And so sure enough, I sell this call and somebody's going to pay me between $63 and $65 for that. So that's cash I get to keep today. That's money I get. And mathematically speaking, there's a 75% chance, actually, it just dropped to 74. So there's a 74% chance that this option will expire out of the money, which means there's a 74% chance US Steel is not going to expire on June 18th at $22 a share, right? And so 74% of the time when I make this trade, I'm just going to keep that 63 bucks, right? That's 31 days from now, right? Today is May 18th. You can see the 31 days away. So that's 63 bucks. I can make 63 bucks in 31 days, which is exactly a month, for really doing nothing. So 75% of the time, I'm going to keep this money. Now, if I look at the profit loss curve, this is what it looks like, right? I get $63, let's say, and it's gonna just basically sit there. It's gonna expire out of the money. I get to keep that 64. And you know what? I'm gonna make that trade just to see what it looks like. I'm gonna hit review and send. And I got it. Awesome. So we're gonna take a look at that in a minute as well. But let's go back to this thing, right? So as long as this stays above $22, I get to keep my 63 bucks. Fantastic. If it starts dipping below $22, my break even, you can see right there, my break even is around $21.40, roughly. And so as long as the stock doesn't go below $21.40, I won't lose money. And if it goes below 21, then I will lose a little bit of money, but I'm not worried. All right, that's the closing bell, so I just sold that option just in time. All right, so again, what's the point of doing this? The point of doing this is I actually don't want to take these shares. The real reason I'm doing this is because I just want to get my $64 a month, right? Between now and the end of June, I'm going to have 64 bucks. The risk I take by getting $64 is that if the stocks do go lower, then I either have to buy this options contract back at a small loss, right? Or I will have to buy 100 shares, whichever one I want to do. Usually a day before expiration or on the day of expiration, I will decide, do I want to close it? Do I want to keep it? Whatever. Some people like to close this 5 days or 10 days before expiration. You can close this anytime. Another way to look at this is, if I look at this position, now actually it's showing -1 there because I own it now. But if I look at my position here, you can see it there, X. There's my option. I bought it today. It's been open for 0 days. It's expiring in 31 days. And the theta is 2.25. What this means is this options contract is going to expire. It's going to lose about $2.25 each and every day on average if the stock doesn't move. I like to look at this graphically as well. So we know that this expires on June 18 at 22. So if I look at the chart, let's look at this. I said $22. So let's change this to 22. as a price level. So that's the price level. And I'm going to add a time level of June 18. Let's try to do this quickly here. June 18. Oh, it is June 18. I nailed it. Awesome. So if I zoom in, this is the graph. So you can see here, US steel has been bouncing up and down. It went sideways for a little bit, up, a little bit down, a little bit up, a little bit down. So this is my line. If I start to project this into the future, you can kind of imagine the lines going up and down, another jump up, another jump down. As long as it stays above this line, I get to keep my $64. If it goes below this line, and you can see it does happen, right? It went below this line on April 30th. It went below this line for a couple of days on April 20th and 21st. I mean, it can definitely happen. At that point, I will decide, do I want to buy 100 shares or do I want to close the contract at a loss? Another option is to roll the contract, which is just basically closing out the contract at a loss and opening the same position in a future month. But we'll get to that in a future episode. Right now, the only thing to think about is it's a bet that is going to pay out for me 75% of the time. And I know that because there's a 75, right? I want this to expire out of the money so I can keep my money 75% of the time. If I make this trade 100 times, 75 times, I'm going to keep the $64. All right, that's 7 minutes. Thanks, guys.